Merchandise companies return merchandise from time to time, are granted purchasing or payment discounts for paying early, and allowed trade discounts if they purchase large item quantities. Let's talk about all of that and how accountants record these transactions. The purchases, returns, and allowances and the purchase discounts are contra expense accounts with a normal credit balance. Trade discounts are not typically recorded in a separate account. They simply reduce the amount of the purchase. When merchandise arrives, it is examined to confirm that it's satisfactory. Occasionally, the wrong goods are shipped or items are damaged or defective. A purchase return is used when the business returns the goods. The supplier issues a credit memorandum for the return, and the credit memorandum reduces the amount that the purchaser owes. A purchase allowance is when the purchaser keeps the goods but receives a reduction in the price of the goods. Purchase returns and allowances are entered in the purchases, returns, and allowances account, not in the purchases account. And just like a credit memorandum is issued for a return, one is also issued in a situation where the vendor gives the purchaser a reduction in price. The purchases, returns, and allowances account is a complete record of returns and allowances, and business managers analyze this account to identify problem suppliers. Purchases, returns, and allowances is a contra expense under cost of goods sold. The normal balance of cost of goods sold accounts is a debit. The purchases, returns, and allowances account has a normal credit balance. Some suppliers offer trade discounts, like for instance, if a business buys a certain quantity, the per unit price is reduced. An example might be for a quantity of less than 10, the unit price is $20. For a quantity of 10 to 20, the unit price is 18. And if the business buys more than 20, the unit price is 16. That's a trade discount. Also, sometimes suppliers offer wholesale discounts, which means that all business customers receive an additional discount. A purchase discount is a reduction in payment because the business pays early when the supplier offers payment terms of, for instance, 2%, 10 days. Here's an example of how Max Out Sporting Goods records purchases, returns, and allowances. Max Out Sporting Goods received merchandise costing $4,760 from Modern Sportsman on January 15th. Invoice $1,100 with freight charges of $360, paid by Modern Sportsman and added to the invoice. In my prior video, we recorded this purchase with a debit to purchases for $4,760, a debit to freight in for $360, and a credit of $5,120 to accounts payable. Unfortunately, some goods were damaged and the supplier granted a $476 purchase allowance on its credit memo 103 of January 27th. When we analyze this transaction, we find that accounts payable decrease because of the purchase allowance. Accounts payable are a liability, and liabilities decrease with debits. Max Out also now has more purchases, returns, and allowances, which is a contra expense account, which increases with credits. So we debit accounts payable and we credit purchase, returns, and allowances. We prepare the journal entry by entering the date into the date columns, write accounts payable into the description column, and $476 into the debit columns. On the next line, we write purchases, returns, and allowances, and a credit of $476. When Max Out Sporting Goods pays Modern Sportsman, we debit accounts payable for $4,644 and credit cash for the amount of the original invoice of $5,120, less the credit memo of $476 for $4,644. Here's an example of a purchase discount or early payment discount. Max Out Sporting Goods received merchandise costing $3,000 from Modern Sportsman on January 10th, invoice 880 with terms of 2% 10 days or net 30 days with freight charges of $200 paid by Modern Sportsman and added to the invoice. We analyze the purchase transaction and find that the business now has more purchases, which is an expense, and that expense accounts increase with debits. That means we debit purchases. Max Out also has more freight in charges, which is an expense account and increases with debits, so debit the freight in. Accounts payable also increased, which is in a liability account, and liability accounts increase with credits. That means we need to credit accounts payable. We record the purchase by writing January 10th into the date columns, purchases into the description column, and a debit of $3,000 into the debit column. On the second line, we debit freight in for $200, and on line 3, we slightly indent and credit accounts payable for $3,200. On January 19th, within the 10-day time period for taking the 2% purchases discount, Max Out pays the invoice due with check number 150. Please remember that the 2% is calculated excluding the freight. So in this case, $3,000 times 2%, which is $60. The amount due is $3,140, which is $3,000 minus 2% or $2,940 plus $200 freight for a total of $3,140. We analyze the transaction and find that the business now has less accounts payable, which is a liability, which decreases with debit, so we debit accounts payable. Purchase discounts increase because the business is taking the purchase discounts within the 10-day time period. Purchase discounts are a contra expense account, which increases with credits, so we credit purchases discounts account. The business now has less cash. Cash is an asset, and assets decrease with credits, and that means we need to credit cash. To record the transaction, we debit the accounts payable account for the full amount of the original invoice of $3,200, credit the purchase discounts account for $60, and crediting cash for the payment of $3,140. I hope this video about purchases discounts and purchases returns and allowances was informative and helped you understand the journal entries that accountants record for these type of transactions.